Welcome to StockOdds Odds and Podcast. It's Saturday here. We're trying to be early and get a head start on the week ahead. Good evening, good afternoon, Rob.
We're back to our goal here of Saturday. Well, we'll see if that can continue. Anyway, yeah, doing great. Nice sunny day out. It's National Truth and Reconciliation Day today in Canada. The TSX is not closed on Monday as far as I can tell. I mean, it's a relatively new holiday that's falling on a Saturday. So then it is a stat on Monday for people that, are employed. They do get stat pay on the Monday, but it doesn't seem to me that I can find the TSX being closed. So anyway, because sometimes when the Canadian markets are closed, it does impact volume even on the U.S. markets because institutions are offline that trade both places and so on. So anyway, let's move on through this here. So Friday we had consumer cyclical and technology that had held up pretty good. Energy pulled back significantly on Friday, having been up for the week and for the week and also for the month. So energy was the best performing in the month of September, but it did pull back on Friday. We actually had, I won't show it today, but we did have a positive expectancy for seasonality on the last trading day of September. What happened is the market sniffed that out and for various reasons got kind of a jump on it on Thursday. So sometimes that happens. Market runs ahead of an event. But that might have been why energy pulled back on Friday, just a bit of rotation there. As far as other things, based on rates, there's a fairly significant bond component in utilities, and they've been suffering on the 1 week. That was a very big hit for utilities for the week and also for the entire month. So it's part of this rate implications. Rates were sneaking up. The US dollar was stronger, and so that can affect utilities. And also, it does, kind of put a lid on basic materials, but they fared okay for the month. But seemed to be for me, what were your observations, Dave? That seemed to be still a fair amount of risk on, like even throughout the month of September, which was softer. Mega caps were still trying to rally quite often. And so we had a bit more of a risk on, approach. And you can see that with up here, 1 month communication services and, holding up pretty good. Consumer cyclical in the middle. So kind of a battle between defensive and cyclical for the month. But for this week, technology and communication services and cyclical did well. So it was essentially a risk on week much of the time. And then Friday, we saw that come through again. So this is the weekly chart of the XLE. And you can see that it had almost the same range as the previous week. But the previous week was a down week for energy, and this week was an up week for energy, with the exception of that minus 1.65% pullback on Friday. So this is kind of putting us a bit on a ledge. We could recover. It depends on the prospects for October seasonality. Now, from the middle of June all the way through till, really this month here, energy's been stronger. And so maybe it has run ahead of even that seasonality to some degree. So we'll take a look at that from our almanac. Here's the ETF performances for week, month, so on. I wanted to point out that, again, consumer discretionary held up for the week, energy, basic materials, Qs and IWM. It was the Dow and the blue chips that were really suffering for the week. SPY was down, but not as bad. So again, some of that mega cap exposure. And just a reminder that the Dow is a price weighted index, and the SPY is a market cap weighted index. So that's where you get your differences of those large, magnificent seven, or the FANGs, they call it, being kind of in charge often of what happens in the world of the S&P 500 for the day. Now, you can see your performance for the month. Again, there's at energy. And what was the worst performing for the month? We had a battle between the utilities and the REITs. And again, these are all sector spiders. So that's only related to the S&P 500, whereas the previous bar chart that I had for all of the sectors includes, bringing in more of the mid cap and some small cap too. So it's a broader sector approach. This is defined by the sector spiders, which are S&P 500 only. Now I want to show you the relative volumes here. They're all over one now. So when we were in August, we were running at relative volumes that were below one. That persisted for the first couple of weeks of September. We did mention how that kind of plays out. Then institutions kind of get back to work. A little bit reluctant. They had ahead of the FOMC. Volumes picked up after the FOMC meeting. And still a little bit of a reluctance, though, with the government shutdown potential and so on. So, but you can see the volumes have picked up on a relative basis. Again, that's comparing what's currently happening with the 90-day average volume. So also looking at where they are in terms of beta or ATR, just a reminder that XLP is defensive, consumer staples, right? Consumer defensive. And so its beta is relatively small, as well as utilities is, and also healthcare. So when you're playing this risk on versus risk off approach, it's part of a beta exposure as well. And that's often why sometimes when the market gaps up a lot, if you go short your higher beta and long your lower beta, you get that snapback as many of those higher beta stuff open too much, and pull back, kind of a gap fill opportunity there. And so that's why sometimes on gap ups, the risk off or defensive posture works well for your longs, and the shorts would be your higher beta, riskier type assets. And the reverse is true when we're gapping down a lot. Now, again, you still have to factor in what's happening on the macro, what are the catalysts, what's the seasonality, things like that. But that kind of simplifies it a little bit if you understand the relationship of your sectors to the S&P 500. So the S&P would be 1, as you see here, 1.01. And so, 0.6 means it's going to move 0.6 as much as the SPY does. So when the SPY moves up 1%, this should move 0.6 of 1%. So there's a lagging relationship there. On the other hand, energy is more volatile. It has a much higher beta. So we don't, in our risk on and risk off lists, we focus on, as far as the long sectors for risk on, we focus on XLK, XLC, and XLY. And for our long sectors for the defensive, the risk off, we focus on XLP, XLV, and XLI. So again, you can see the betas being much smaller. So it's also good to look at where things are sitting relative to their simple moving average. You've got your 20-day, you've got your 50, you've got your 200, and you can see which ones are above or below. So if you're looking for some extremely good mean reverting opportunities, one would be in, say, the XLB category, which we saw from the monthly, basic materials was kind of sandwiched in the middle of all the other sectors. But I mean, it's significantly down. If there is a pullback in the US dollar, and the seasonality is good for basic materials, then you kind of have a winning combination in the fact that, it's well below its 52-week high, it's below its 200 below. So we have some targets for it to strive to go and reach. Okay. So just keep that in mind. You can explore that on the video yourself here. Just pause it and kind of look at this. And here's a 15-minute chart for September 25th to 29th. I included the Friday the 22nd. You can see that we had a volatile session where we had some wonky stuff right at the end of the day. And we closed here. We opened a little bit lower on Monday and rallied nicely for the day. A little bit of a 15-minute move right at the end of the day, which can often happen. Next day, we gapped lower. It did not fill the gap, and it proceeded to move down. That was followed again by opening premium, and they sold it again, and then finally rallied back near the end of the day. And then on the 28th, this is where they kind of got the jump on the last day of the month being stronger for September. So this last number of days was supposed to be weaker, and September really has gone as the almanac suggested. I mean, it's not been an out of the ordinary type of a month. Would you agree with that, Dave? It's kind of been as expected, softer, right?
No, totally.
Yeah. So and then Friday we jumped up, so there's that premium, and of course conveniently got sold as there's some concerns about, of course, the government shutdown and things like that. So that was your week. And now let's just look at the 1 hour chart for the month. So we closed August here. We popped up right on September 1st. It was expected to be a softer day from open to close and even from close to close, and it did not disappoint. It acted as that and pulled back. And then we proceeded to have like a little bit of a mid-month rally here into expiration. So there was not expiration day itself because that was expected to be down, but we just had a rally just before that. And then we pulled back after expiration, and we had the FOMC, and we dropped. And then you ended up kind of having a bit of a rally right at the end here. Again, this is a 1 hour chart, so it's not a daily chart, so you can just see how it progressed throughout the day. Anywho, that's that. So let's look at the map of the market live here. We get this from FinViz. So this is the 1 month performance. You can see the bright spots in terms of energy, Exxon and Chevron doing really well, and they're the majority of XLE, the sector ETF. We can see some standouts like with Amgen and the rest of them not doing so well for the month. Differences between like Costco and Target, or Costco and Walmart even. Meta and Google difference there. Intel and say AMD difference. And I find that's always fascinating, sort of the polar opposite of how well Intel did for the month and how poorly AMD did for the month. And, they are competitors, obviously. So that's the 1 month. Let's look at the 1 week here. You can see some green that firmed up in the semiconductor area. That helped this week with the risk on and the technology. certainly helped a lot. Again, for the week, we saw energy doing really well until, of course, the last day. In the discretionary area, or consumer cyclical, we call it, Tesla, big contributing factor to that performance on any given day, and it did really well. We also had Nike doing well, Airbnb, so some discretionary stuff there kicking in. Credit cards were down. I mean, there's some pressure on, transactions these are transaction based, Visa and MasterCard. So not the same as a lending institution, but we can see the pressure on the consumer coming into play here a bit this week, as we're expecting rates to stay higher for longer, right? So that can help the banks, and you see some of the regional banks still holding up okay, but definitely the payment processors it can harm. And let's go to the Friday just to see how things played out. There's your Exxon and Chevron pulling back on that Friday. Discretionary stayed okay. Communication services pulled back a little bit. Along with, of course, communication has a beta of pretty much the same as the SPY. So SPY went down on Friday from its open. Then you see a standout here on Friday with Pfizer going the opposite way of the other healthcare. Okay, and then we're going to look at, let's just take a look at some of these futures here to see where we're at. Let's look at the US dollar. So we had a pretty substantial run. You remember our target that we talked about, this resistance level right in here? Well, we did get above that briefly, and then they ended up selling it, kind of like that banging the gopher on the head thing. I mean, it popped up and they knocked it down for a couple days, but it did recover on Friday. It kind of had a midday reversal. It still impacted things because it was down sort of pre-market, and it did sell off earlier in the day. So it did impact things that are sensitive to the dollar. And that's where we sit here. So we could recover. This could continue. I mean, we talked about the bit of blue sky up here for the dollar still to be able to move. So it's something we have to watch carefully. It will depend on what happens here with the budget, the government shutdown, all that kind of stuff. That's going to be important, and how this responds. As far as our treasuries go, well, we can look at the 30-year. Let's look at the 10-year, a little bit more widely followed. We see it was moving lower for the week until it kind of bottomed out there on Thursday, and then popped up again on Friday. So it popped up on Friday there. So this means that, rates were rising, and then they tapered off a little bit. It's a little bit of relief for the Thursday rally. And Friday we opened higher, and then of course pulled back. So in the metals area, we see gold pulling back because of that strength in the dollar, and it did not bounce though when the dollar pulled back. So that's an interesting observation. We've broken this resistance level here, so keep that in mind. We've broken the resistance level, or support level. Dave, you should correct me when I get off track here. Support level, unless I put you to sleep already, okay? So this is the support level for gold, and we did violate it, and it went lower. Silver is still at support. Copper is obviously related to recession and the green economy and all that too, and it's holding up okay. What else we got going on? For people that follow Bitcoin and stuff, it's still in a very tight channel, and there is some concerns about the Binance and stuff like that. So this will be interesting to watch what happens in the months ahead. Let's What else we got? So let's go back here to, why don't you go through the calendar here for a second, and I'll circle back, Dave.
Yeah. In terms of U.S. economic reports, there's two major themes for the week. One's the state of the economy, and the other is employment. And they have these PMI reports coming out. It's Purchasing Managers Index, and it's a broad, again, economic indicator, shows the direction of economic trends. So they have one for manufacturing and one for services. So Monday, we have a manufacturing PMI, and then on Wednesday, we have services PMI, and as well as some construction spending on Monday. Tuesday is jobs opening. Wednesday is ADP employment report. And Thursday, initial jobless claims. And then Friday is the big one, U.S. employment report. Every first Friday of the month, there's these employment reports. It's U.S. employment rate, and hourly wages. So those are to be the backdrop themes of the week. And in terms of earnings, there's not many earnings this week. Some key names are Levi's on Thursday, McCormick, the spice company, on Tuesday, and Lamb Weston on Thursday. So think of hanging out near Levi's, having seasoned potatoes, right? Toasted. But there's not much in terms of earnings anymore.
Okay, let's go look at some seasonality from our almanac here. So, Dave, I can get you to comment on this. So this is the monthly for October. So this is kind of the big context of stocks. Maybe we should look at ETFs first here.
Sure.
Back to the report here. Got a problem with this here. Got to go back to October here. So, ETFs. Okay, so let's look at the month. So those are our ETFs for the month. What stands out for you on that?
Yeah. 1 second.
I mean, a lot of people think October is a down month, but what we're seeing here from the 175 ETFs that, well, some of them you got to realize are leveraged, or there could be inverse or whatever. But what this is really saying when we look at this is that there's a positive skew to the month in terms of the ETFs, right?
Mm-hmm.
So UPRO, right? Banking, KBE, KRE is supposed to be stronger. So if we can get past this government shutdown stuff, this is what's supposed to be stronger. Utilities. Now that's an interesting one, Dave, because we've got 88.9% probability of 2.82% move for utilities for the month of October. And we know that it's been down substantially on the weekly and the monthly, right?
Yeah, we're coming from a very discounted position, so the risk to reward on that one seems really good.
It does seem really good. I mean, it certainly could be downside, but I think that the downside risk, a lot of it's already been factored in with the rates. And we should, isn't this story getting a little bit old now,
Mm-hmm.
with interest rates higher for longer and possibly another rate hike this year, either in the October or December meeting? So isn't that story kind of old by now?
Yeah.
I think so.
I was thinking another situation that's similar to the utilities is oil, right? We had a huge month in September, and it's expected to be down minus 4.88 with a 77% odds for this month. So that's also very similar kind of advantaged trade possibly.
Right. Absolutely. And so again, just to refresh people, you're looking for odds that are higher than 50 for going down, or odds higher than 50 for going up. So XLE is 77.8 of being down. Now, not much. We're still in hurricane season and things like that. I mean, you could have a macro interference with that. You could have, war drums again interfering. There's all kinds of things that can happen. But we did get a whisper of maybe OPEC, changing what they had said originally. So there's a bit of whisper of potential easing on the cuts and putting more supply into the market. Of course, it's to their benefit if prices have risen to sell more, and if prices decline to sell less, right? So we've had that rise, so it makes sense. So I would be definitely looking at, if the energy backdrop is softer for the month, and utilities, is more bullish for the month, we could have some good mean reverting scenarios there, right? Look at the gold stuff. It's softer, and maybe that was why we saw gold not responding to the US dollar pulling back slightly like it normally would. Maybe they're thinking about the month ahead. The market does factor in everything that it knows or can anticipate, right? So it does tend to run ahead of something that's expected. This calendar kind of shows what's expected.
Mm-hmm.
I don't blame people for kind of posturing ahead of it, right?
Mm-hmm.
Anything else you want to comment here before I flip it to the stocks?
No, I'm just thinking the backdrop of the month, right? So gangbusters, first trading day of the month, like the NASDAQ strong, 0.5%.
Oh, well, okay, I got to flip over to that then here.
Oh, you're going to show that, yeah.
Okay.
But the theme is a really strong first day of the month and a mid-month seasonality that's really powerful. So those two.
Well, and it's interesting because we did rally on Thursday, we did rally on Friday at the open, and we pulled back.
Mm-hmm.
And so it could be setting itself up for a good turn of the month effect from the discount kind of Friday into that premium. So I would be anticipating that we could open up on Monday. Again, we got these other macro swirling things around, and we'll talk about another thing here shortly. But you can plan for that, but it may be interfered with. That's all.
Mm-hmm.
Okay. First Friday down. When's the first Friday? So we've got a full week this time, right? So that's interesting. Like September, the first Friday was the same as the first trading day. So that this way it's separated by the 5 days. Mid-month seasonality is pretty bullish for the month, August, and then the last trading day of the month is down. And then November is usually a pretty good month for breadth and all that.
Mm-hmm.
So you guys can put in, different ETFs to look at how they relate, right? So if you see anything on the main calendar, go pop it in here and compare it to the SPY. Let's flip over to the symbols for a second. See if anything comes out. And again, you can slide these sliders for, price. It's probably good to keep it there. You don't need it at 302,000. That's irrelevant. But volume, we've got 200 million in dollars turned over is how it is, not shares. So you can move that around too. I would keep the events kind of at 5 to 9 because you need enough samples to get some merit there to that. But these are the symbols that are supposed to do well for the month of October versus do poorly. So AMD, go ahead.
Generac, right, on the long side, it's expected to do really well, 13.45%. And plus, we have this natural disaster in New York, right? So usually when there's natural disasters, it tends to get a little bit of extra juice in it. So what do you think about that one for the month?
Well, yeah, I mean, I like Generac for the hurricane season anyway, which we're not out of. I mean, it's been a quieter one, but the temperatures in the Gulf are still very elevated compared to historical averages. So we could still have a hurricane yet that's of substance. And yeah, so I really like the Generac opportunity. It's a good one to point out. We also have on the short side here. So Etsy, specialty retailer, like depends on whether it really ran in the last little while, because when you come into August through Black Friday in November, that's when retailers can often do the best. So if it's saying that it's going to be down for the month of October, well, I would really compare what it had done previously. And I think that context is always important, because if let's say it had a really bad September, I wouldn't lean into it.
Mm-hmm.
Right? That may not go your way, right? So that's the way to look at it. Going into, even you could take a monthly approach and say AMD is expected to be down for the month. Well, that may not happen for the whole month. It could happen at the start of the month. And if we look at how did it do last week, semiconductors in general did okay. Maybe that's the trade. And then, of course, you can go and look at the first trading day of the month, which is coming up, right? And we saw already that it's supposed to be pretty bullish. Well, look at your symbols here, right? So I would again pick out things that are in keeping with the ETFs. So let's say basic materials was supposed to be bad for the first day. Well, then I wouldn't necessarily put all my eggs in the AA basket, right?
Mm-hmm.
That's how you look at it. It's like, yeah, that might be historically there, but let's also tie it in with what the ETFs are doing. So that's the first trading day of the month. And then, you look ahead to the first Friday of the month, right? And that's a little bit more balanced in terms of longs and shorts, right? So the first day is very one-sided for longs, very few shorts. So people sometimes do this. They pick out a basket of longs and they hedge with the SPY, or the Qs or the diamonds. So you don't always have to, get equal amount of longs and shorts. It's what we do with our subscriber lists. We kind of go 11 and 11 or 10 by 10, but it doesn't mean you have to do that. You can pick out a basket of longs that you really like and hedge it with the sector ETFs, or hedge it with the market ETFs like the SPY, diamonds, or Qs, right? So lots to play with on your seasonality almanac calendar. And then what else we got? Oh, let's go into the New York flooding. So flooding, in any jurisdiction can have direct and indirect effects on businesses, including loss of business premises, tools, vehicles, and goods, devaluing of assets. It can have a negative effect on the stock market, especially located in New York. And think about the transportation issues. They are already kind of drying out as of the last few hours. They're starting to, ease, but there's still some disruption potentially to transportation and stuff. And it may mean that, people don't go to work, right? So there's less volume, or there's just a negative sentiment because you've just been through, the great flood of 2023 in New York. Disruption to telecommunications, that could be a problem. Sewer related problems, that's never fun. Access to clean water, right? Power outages, all that stuff. So flooding has damaged subway lines, homes, and vehicles. The city lost at least $25 billion in estimated business activity. Financial implications are still being assessed, but here's some companies that are likely to be affected, or like companies in these groups here. Property insurers. Now, that's kind of both ways. Sometimes when you have a natural disaster and you look at the property insurers in the area, you think automatically that those insurers have to go down. But often, because of the event, it gives them the opportunity to sell additional insurance riders like overland water rider or whatever. It gives them the opportunity to raise prices, maybe, maybe they have, enough to cover losses without a problem because of the way they've positioned themselves, the way they've hedged, all kinds of different, things that they do. So they need to be very creative in their asset management. Property insurers do. And so sometimes when you have a national disaster, it doesn't mean that the insurer drops in price, but it can. So I would watch for that. Billions of dollars, right? Construction companies, they're likely to benefit from repairs. So GDP is increased after any of these events. We saw that with Katrina, like massive increase in GDP afterwards. Construction companies benefited, restoration companies, cleanup companies, all kinds of stuff. Engineering firms, you need to, now scramble to say, okay, well, we may be impacted again. So how are we going to deal with this next time in a much better way? So what needs to be improved so engineering firms can benefit? Small businesses, they're particularly vulnerable, of course. They don't have flood insurance, maybe not able to repair. So supply chains can be affected. Tourism can be affected, also hospitality. So some of your discretionary areas. So the New York trading community may respond in the stock market kind of based on what they're actually experiencing in their hometown, their home environment, their home locale. It doesn't necessarily mean that's appropriate, but that can be the response. And I've seen this before. So just keep that in mind. Here's some actual companies that may be affected. Con Edison, it's the electrical utility company that serves New York. Reported that more than 20,000 customers lost power. The Metropolitan Transportation Authority got everything flooded. Amazon, e-commerce giant, had a fulfillment center in Staten Island that was flooded. So it was closed for several days, could lead to delays in shipping. That could impact the price of Amazon slightly, and it may have already. Home Depot has some stores that were flooded. Could lead to loss of sales. So blah blah blah. Insurance, well, again, some people can be spurred to buy it. Others say, well, what's the point now, right? So anyway, any comments, Dave?
Lots in the background for the week, so should be
yeah.
interesting.
And if you have your ability to do spread charts like with TradingView or whatever, you can sign up to TradingView for free to give you the ability to do daily spread charts. Again, look at your value versus growth. Look at your diamonds versus IWM. Some of the things that we've shown you before. So why we bring these about is not to have you rely on us for everything, but to give you some ideas of what you can do for yourself and how to stay informed. Okay. So hopefully it's been educational here. Looking at the week ahead, really, it's really about the turn of the month effect going into October, and that's supposed to be fairly bullish. So we'll see again what the pushback is from the macro stuff, and then the first Friday. So you've kind of sandwiched between the first trading day and the first Friday. So you can look at your seasonality calendar for all of your stuff. And again, evaluate where things have come from, not just what the expectation of where they're expected to go, whether bullish or bearish. Where have they come from? Very important. All right. Thank you for your time.
Good luck.